Welcome. I'm jkoicim, and we're here at New York City Multifamily Podcast, of course, with my partner, Seth Glasser. And we are graciously featuring the legal 1031 exchange team, Todd Pajonas and Matt Scheriff. Thank you for joining us. I think we've known each other for 20 years, done hundreds of transactions, some you don't even know about, some of the referrals we've given over the years.
That's right.
Welcome to the show, boys.
And we appreciate you being here.
Thank you for having us.
Yeah.
Thanks for being our featured guest. So a lot of people want to know, what do you do? What is a qualified intermediary?
We're professional podcasters.
I like it.
So a qualified intermediary is basically the middleman between your sale and purchase transactions. Our role really is threefold. We prepare the necessary documents that the government requires to turn your sale and purchases into a 1031 exchange. Another role is that we hold on to the proceeds, the net proceeds between the sale and the purchase. That's another requirement. And the last, which is probably the most important part, which is the differentiator between qualified intermediaries, is the service that we give, the hand-holding. Because although Matt's a CPA, I'm an attorney, we're technically not allowed to give tax or legal advice. But what we can do is give information. So as long as somebody's not asking us, what should I do? The information that we give, the experience, the guidance is what's most important in our role.
Yeah.
Anybody can do the paperwork.
So what advice would you typically be giving that would be different than someone's accountant? Like, why would what type of maybe basic or common scenario would a client call you and ask you advice versus their accountant?
Well, if I could even just step back one second, just the why of why we're involved. The tax code is going to require that there's an intermediary involved on a 1031 exchange. So that's a common question is, what do we do? And then why do we need you? So that's kind of the follow-up.
People ask us that too.
So I just wanted to mention that. So in order to proceed with the 1031 exchange, the taxpayer will need a qualified intermediary to step in and perform the functions that Todd just referred to.
Okay.
As far as the differentiation, the taxpayer is still going to have their attorney, their CPA involved, their realtor.
We're brokers, sorry. We're not realtors.
Broker.
Okay. I hate that word. My mother-in-law's a realtor.
Our focus is to help clients in setting up the 1031 exchange. We're not allowed to provide tax or legal advice, but we are, as Todd mentioned, we very much are providing information. We're helping clients understand what their options are, very specific to the 1031 exchange. And many times their advisors may not know all the specifics, the ins and outs. They're more generally, their knowledge base is more generally tax return preparation or real estate closings, whereas our expertise is really specific to the 1031 exchange and the rules that really apply day to day for these clients that are doing exchanges. So we can come in and help them with the structuring, the setup, and getting them through that process.
Do you mind just breaking down for the audience, just very simply, the rules of the 1031?
Sure.
Yeah. Todd, you want to take that?
Yeah. So basically everything starts with the sale. So when you have the sale and more technically what the IRS calls the benefits and burdens of the property transferring. So deed crosses the table, money comes back, you have a sale, right? So that sets up the timeline for a 1031 exchange. You have a total of 180 days in which to purchase the one or more, what we refer to as replacement properties. And then within that 180 days, you have the 45 days to identify, which is provide a list of potential properties. And the one thing is when people hear these deadlines, and I'm sure you're both no stranger to this, is when you tell them, oh, you only have 45 days to pick your property. A lot of times people will freak out because of that. But what's important to remind them is that you have all the time period of your marketing of the property, and then you're getting offers, and maybe then you're more serious about what you're looking for, and then you're in contract, and you have that period of time plus 45 days. So if you wake up on the day of your closing and start looking at properties, you're really behind it. But if you manage the process, and that's where a team like you guys who have experience comes in, then you're managing that process, and the purchase is much less rushed, and there's a lot less angst towards
the
it.
Clock really starts. So it takes Joe and I, let's say, 90 days to market a building and sign a contract, and the buyer takes 90 days to close because he's got to get his debt lined up. So that's 6 months just from our perspective, from when we start until we finish, and then the clock starts. So it's almost like a 12-month process,
Yeah,
really.
sometimes you actually have too much time because you find a property, but you're not ready to close. So it's almost like two parallel transactions. You never want to let one get too far ahead of the other one.
And over the years, we worked very hand in hand with you guys, right? Closely on meetings, getting the client prepared, because it all comes down to the preparation and making sure the client, the seller of that property, is aware of the timeline and condensing that timeline depending on, when he or she has located the upleg, right? And making sure that's done correctly. And, obviously you've seen some pitfalls throughout the process, throughout your career. What are some of the common pitfalls that you've seen besides just the lack of preparation?
That's number one.
Yeah.
Lack of preparation is number one.
Yeah.
I had a client years ago, a Mark Smelchak client, who at the closing, we happened to be at the closing, which is rare for a qualified intermediary, and he says, tomorrow I'm leaving to go to China for 3 weeks. And he had not picked out any replacement property yet. We're like, what are you doing? You're sabotaging yourself. He had a $15 million sale. He actually canceled his trip at the behest of all the advisors in the room. So, not planning is number one. Why don't you take another one?
I was just going to say, the 180 days is usually more than sufficient for people to close on the new replacement property. But that 45-day window to identify the replacement properties, that's critical. That's the make or break of the 1031 exchange, because once that 45 days expires, that taxpayer is locked into whatever properties they've identified. Common question is, can I go back and change or modify the identification after the 45 days? And
can you?
No.
Yeah. Are you guys in charge of you guys submit the ID sheet to the government? Is that part of your role in the process, or no?
We don't submit anything to the IRS. It's just we create a documentation trail, an audit trail. So in the event that the transaction is ultimately audited, the auditor is likely going to ask for a copy of the identification statement. The identification statement should be in writing, signed and dated, and unambiguously describe the property. So that's a critical piece. And planning, as you mentioned, preparation is the best advice I could ever give a client. I was saying to Todd yesterday, I've had clients refer to the 45 days as the worst 45 days of their life. It's not a reflection on us as the qualified intermediary. It's just without proper planning and preparation, it's a real race against the clock to get out there and try and find good investment properties to reinvest in. It's obviously the goal here is to defer the tax, but the worst thing a taxpayer can ever do is make a bad investment decision just because they're trying to defer the tax.
Yeah.
And I constantly say that to people. Making good investment decisions is the priority here. You don't want to fall short on the investment selection just to defer that tax. That's a bad recipe.
I think that's well said. And I think a lot of sellers are scared of making bad moves. So that's why, working with us, and, we've had a lot of clients where we bring you guys in early on in the process to understand the timeline and what's available out there in the market, is a better recipe for not a disaster. Right?
Do you guys find yourself in the audit conversation? Like if a client gets audited, do you guys typically get a phone call to help defend the audit?
Oddly, we have provided guidance, but oddly enough, and I can't say this as a reflection of, we're so good and other companies are so bad. A lot of it has to just do with luck, how you get audited. So a lot of times the attorneys, the brokers that we work with, their clients get caught up in an audit and their existing qualified intermediary. And this is where, the service component comes in, just says, here's the paperwork from your transaction. Good luck with your audit. And they don't really help them. So we've been brought into, I'd say client-wise, Matt and I have each been doing this about 25 years. We could count on our hands and have a lot of fingers left over for the amount of audits that we've been involved in for our clients. And again, that's just luck of the draw. But we've been involved in many, many more where we're helping out clients or referral sources understand, the audit that they're in. Because we've had situations like, don't forget, everybody talks about the IRS, but the states are way more aggressive than the federal government. And you can even be audited by New York City. So whoever has a capital gains tax component to your sale can audit you for that. And we were involved in one, not for our client in New York State, where they were dead wrong And it's
the client or the government?
I'm sorry, the government
Okay.
was just dead wrong, and it really wasn't an opinion, but it was a lack of understanding by the auditor that kept it going. And
Can you describe the scenario simply? Do you remember?
Yeah, it was really easy. What happened is, instead of the money flowing through the qualified intermediary, they were closing on the sale in the morning and then closing on the purchase in the afternoon. So they got a check for the proceeds made payable to the seller of the replacement property. Yeah. And that's completely legal. And somehow in the audit, this got uncovered, and New York State said the money didn't go through the qualified intermediary, and the client had the check, and somehow that equaled control. Never mind that the check was made payable to the seller of the replacement property, and it was really the attorney holding on to it. And this went on for 6 months and a lot of legal fees before New York State did go away. So
interesting.
Do you have any other stories, or like some horror stories, or like typos in the ID sheet?
Funny stories are better than horror stories, whatever story you can come up with. Does that exist in your world? Are there any funky stories?
Well, if you want to give us,
I mean, listen. The mistake that happens, and I want to say, luckily, we try and prevent this from happening.
Sure.
But what happens is, say the 45 days falls on a weekend or a holiday, or even if it's on a business day, you have until midnight to turn in the ID sheet. So people will literally fax or email that right up to midnight. And a lot of times we are checking these things late at night. Clients will call us and everything, but we can't always do that. And they'll send something in over the weekend at midnight on their 45th day, and then Monday morning we look at it and there's a mistake. Mm-hmm. Now, if they would have sent it in while people were in the office, now we can't provide tax or legal advice, but we do eyeball it. And if we see an obvious error, then we call them out and say, hey, you checked the 3 property rule and you identified 4 properties. That's inconsistent with the rule. You got to fix this. But if they do it late at night, we don't have the opportunity to help them. That's probably number one that happens.
That is kind of interesting. So this ID sheet, most people probably haven't even seen this ID sheet. Is it like some 20-page document, or is it like literally a Post-it and it's like super simple?
It could be on a sheet of
literally
paper.
what is there like a standard
we
form?
We prepare
for
a
this?
form. We have
so you guys have your own little form, and it's like basically super simple.
The identification form, we use a leading document, which there are some options you have pertaining to the identification. So our document leads through the considerations and helps mitigate some of those exposures of the client filling out the identification incorrectly. So it is a leading document. It helps them consider what their options are. And obviously we're there to support them if they need it.
But you mentioned you're not submitting it, they're submitting it, but you're reviewing it before it goes out.
It's if they ask us to review it, if they submit it prior to as Todd mentioned, a lot of times we receive these identifications on a weekend. If their 45th day falls on a Saturday, the identification is due by midnight of that Saturday. So if it comes across on a Saturday, we may be able to, the beauty of technology these days is we can on our phones open it up and try and look at it. But generally our office is not going to be open on a Saturday to print out and formally review. But if it happens during the week and we're there, obviously our team their role is to look at these and eyeball it and obviously they're not going to know if there's an incorrect. If there's blatant, it's not just the rules. I think going back to the role of our in the services that we provide, yes, there's the rules, and obviously you want to document everything properly, and that's the first line of defense in an audit situation is you want to make sure you have everything in order. But another element of it is when we work with clients, a lot of it is looking at how strong is their tax position? Are there any red flags? It's helping clients assess whether a transaction is conservative or aggressive in a tax matter. And can we help them shift it from an aggressive transaction by changing something to a more conservative transaction to give them a better peace of mind? And a lot of it is not just rules, but it's also, as Todd and I like to say, the optics of things. So it's looking at how, what red flag will this throw up? And even if it's in the right, the last thing you want to do is be audited and have that come into question. So
what type of scenario would that be? Sorry to cut you off, because
no problem.
Like most people have, a single member LLC, or it's a husband and wife, and it's like pretty simple. Like, how could you
we love those, but so the reverse of that. Yeah. The reverse of that is like, say we all owned this building together and you want the money and pay tax, and the rest of us want to exchange. With these smaller partnerships, and especially family partnerships, the dynamics of those relationships and different needs and wants of the clients in a transaction, I would say that's number one that we get involved in terms of discussions to help provide solutions. Because as Matt said earlier, there's lots of good tax attorneys and CPAs and tax advisors out there, but they focus on this much of the tax code, where Matt and I focus on this much.
And this is your expertise, right?
Right.
We've been in many meetings where, is it owned in an S corp? Is it a C corp? How do we
Right.
trade out? Can we exchange these shares
Right.
or whatnot?
Right. So those are the most complicated technical conversations that we get involved in, where we're offering up potential solutions. And then we have, third-party partners, tax attorneys who will do the structuring. We're not permitted to do that, but we can be the initial discussion that says, well, you have 3 different solutions as we see it. And by the way, here, we'll either discuss that with your tax and legal advisors that you have, if they have the capacity to do those, or we're going to introduce you to a trusted resource who's going to help you along those lines. So that is a huge part of our day, having those conversations.
Yeah, helping people unwind.
And
their family business.
even the simple transactions, you mentioned husband and wife, and a common scenario is husband and wife married.
Don't want to be husband and wife.
A lot of times, say the husband bought the property 10 years ago prior to the marriage.
Yeah.
Now they're selling the property. They want to do a 1031 exchange, and they're going to sell that relinquished property, buy a replacement property. Well, guess who they want to put on the deed? Who wants to be on the deed is the spouse. And for 1031 purposes, you want to have the same taxpayer generally on both sides of the transaction. So it's a matter of working with the husband and wife to understand, keeping in mind.
Or the kids are
keeping in
trust,
mind,
right? They want to sell their apartment building in New York and buy a
we're not
Walgreens.
in a community property state, so husband and wife are separate taxpayers. So it's a matter of trying to explain to the other spouse that, listen, we're trying to keep consistency of ownership to save you a lot of money in taxes.
You guys do
So you
marriage
become
counseling too.
exactly.
Perfect.
Divorces are great
You
sources
guys
of
have
business.
a lot of
Psychologists as well, like us.
We do family counseling. Like, let's say all of us own this building. We each have 3 kids, and then we're not here anymore. Now it's 12 people sitting at the table, and they have much different needs. We have one client, longtime client, who has all the property is stuck in a corporation. It's harder to get away. This is a longtime client who sold to like a Fortune 100 company 50 years ago. He has something like 70 people involved in the family corporation, and he says every time he sees a birth announcement, he's like another voice. So family partnerships are way more difficult to navigate, as I'm sure.
Yeah, that's why we typically
business.
sell for them, because they're fighting and they're getting out.
Yeah,
and figuring out where to go.
And we're oftentimes the solution, the path to letting people 1031 exchange and separate without a tax consequence if we can.
Here's a common question that I always get: can I sell my investment property and exchange into a house that I can live in? So we've had this conversation a few times. I know there's a little gray. So.
Well, the requirement for 1031 is that you're selling business or investment property, and you're acquiring other like-kind business or investment property. So a couple of variations of your question. No, you can't just buy a residential house and move into it. That's a personal use property, so it wouldn't qualify as a replacement property for 1031. Now, if you're buying a 4-family and you want to live in one of the units, well, let's just assume pro rata, that 25% value won't qualify for the exchange because it's personally used. But the other 75% that's being rented out can qualify. Now, so there's a variation with a multifamily where you could live in one of the units, rent out the others, and have portion of the property qualify for 1031. As far as the single family house, if you are to acquire that new property, we've always over the years referred to it as a retirement planning strategy. So if you sell the strip center here in the tri-state area, and then you buy the rental home on the golf course in Florida, and you rent it out for a period of time. So your initial intent when you do the exchange is to acquire that property on the golf course in Florida for investment purposes, and it's rented out for a period of time. So after, say, a couple of years of rental time, if you decide to pick up and retire down to Florida, at that point you could change your intent and kick the tenant out and ultimately move into it as a primary residence. But initially, the initial intent has to be as an investment property to qualify for 1031.
One of the things that has kind of come up, and I've thought about it a little bit, is the 1031 exchange disaster extension, I guess, like for disaster relief. Can you guys kind of briefly explain what that is? And then I've got some follow-up questions. But for the audience, why don't you explain what that is and how that could impact somebody's timing for their exchange?
Right. So the 1031 exchange deadlines, the 45 days to identify, 180 days to close, are pretty much written in stone. And as a matter of fact, unlike most tax deadlines, if they fall on a weekend or holiday, they don't roll over to the next business day. That's the opinion of most tax professionals in this industry, except for a minority. And it would make our lives a lot better if it did roll over to the next.
So you guys are 24/7.
Yes.
Well, you know that from conversation.
Sure.
Yeah, but if like something happens, a hurricane or whatever, you have
right. So there's
vision.
So it's a federally declared disaster, and it affects taxpayers, and that's the ubiquitous name for the people or entities that we deal with, the taxpayers or the exchangers. A lot of times, if the IRS the federal government gives guidance that affects these counties and these states. So if there's a hurricane that makes landfall in the Carolinas, they actually throw up a map and you'll see all the counties, and they'll highlight the ones where you're an affected person. And if you're an affected taxpayer, and that could mean anything, you could be up here warm and dry in New York, but your bank is in one of these counties in North Carolina, and the bank is offline for a few days. So you could claim you're an affected person.
Yeah, this was what I was going to ask you. Like, how loose is this? Could it be your bank is in North Carolina, but the property's in Florida?
Yeah.
You live in North Carolina, but how crazy can you get with really helping yourself to, legally go around the rules?
There's lots of different ways that you can latch on, and sometimes people latch on from further away than, there's a little bit of an interpretation like that. So if you can latch on, if you are an affected party, and that's defined, you can get it, and it's generally an extra 120 days. The same extension, though, allows that if you're past the 45 days, if you're within the 45-day window of an identification and you're an affected party, you get an additional 120 days. But if you're past the 45 days, you're locked into your ID still, unless your property is materially affected by the disaster. So what does material mean? So that's open to interpretation. Is a little bit of siding get peeled off the building? Is that material, or does the roof have to blow off? And where's the area in between? That's where the gray area is. So if your building is destroyed, then you get an extra 120 days. But if your building isn't affected, you don't get an extra 120 days to reopen your ID, but you do get an extra 120 days to close. So there's all these different nuances to it. And we put out guidance on that. We're pretty big on that to help clients understand. And then there was the whole COVID.
I was just going to ask.
So
what happened during COVID?
And a mess.
Yeah.
A mess.
Everyone was asking for extension.
So the
I
IRS
can't travel. I can't go
the
to
IRS
property.
has a formula to put out these extensions. And to our knowledge, this is the first time that they ever did a nationwide disaster extension, and especially for a pandemic. And instead of using the same language, and I don't want to be too critical of the IRS because, we don't want them coming and getting upset with us. But instead of using the format that they normally did, they just went outside the box and they used different language, and that language became open to interpretation. And so the amount of time that taxpayer received began to be open to interpretation. And we of course believed that we had the correct interpretation, and there were other qualified intermediaries and other tax professionals who had a different opinion. So how did the COVID extensions go? Poorly. And luckily we got through it, and nobody got audited for the difference in opinion on it, and hopefully that's all behind.
When you say they went poorly, because it was like a shitload of work and it was really confusing,
it was confusing.
But did people get, if you were in an exchange during COVID, were you able to?
You got an extension.
You got relief.
Got it. Yeah, you got relief. But also it was when were you in contract? Right. When did you start your exchange? And there were people that you could argue were affected by the pandemic, but not as far as the government was concerned. So they got a little bit screwed. And so it was very much open to interpretation at one point.
But you were asking, I mean, when people fall into these gray areas, and it's not just in this area, there's lots of areas of 1031 in the tax code where people may be in that not black or white situation in that gray area. And people need to consider the consequences. With the disaster specifically, the disaster extensions, we do work with clients to look at, can you demonstrate the hardship? I've had clients where they were in a bit of a gray area, but they clearly were adversely impacted by the disaster, and they had closings that were delayed because of flooding in Florida. They felt a lot more comfortable taking a little bit more of an aggressive interpretation because they could demonstrate that. There's also a hotline, and I have had clients call, and maybe there's a way that you could get an affirmation, because keep in mind the consequences of a failed exchange. If the IRS or state tax authority disagrees and you're disqualified, you now owe the taxes and the late interest, generally speaking. I mean, there could be punitive if that's a bad faith situation, but I don't think that's likely, generally the case what we're talking about here. Yeah. But if you're disqualified and you owe the taxes and the interest, keep in mind that taxpayer no longer has that cash sitting in the bank. They've taken that money and reinvested in a new replacement property. So now they either have to liquidate some investments or come out of pocket if they have that wherewithal to do that. But there's a tax consequence that's due, and that money's not sitting there anymore. It's reinvested.
It's no longer.
So people need to consider what the implications are and plan for that worst case scenario potentially.
Were there any crazy examples you guys saw over the last couple of years about people really pushing the envelope and redefining gray in this type of scenario to really help themselves?
Well, I would
you
say,
can make a story of it if you want.
Yeah.
No, and if it's fine, if there's not, I'm just this is the type of stuff I think about all the time.
Listen, I would say, first of all, if you're talking about disaster relief and drama with that, it's the person who had one shingle blow off the roof, and they're like, our property got materially affected.
So they're stretching a little
by the hurricane. They're stretching. And listen, you asked, what do we send to the IRS? Something that we say to our clients all the time. We're here to explain. We're not an arm of the IRS. We're not the IRS police or anything like that. We view our role, which is a role different than I think most attorneys and CPAs who try and talk clients out of or into something. I prefer to treat clients like adults and give them the information, because everybody has a different risk level. Right. So where Matt was talking about, if you spent your money and maybe you have a high LTV and all of a sudden you're on the wrong side of this, you get an audit and you owe that money. You can't just refinance out, where say a client who bought a property all cash, maybe they can take the risk a little bit better, because if the IRS rules against them, then they could refinance and they have access to it without having to sell. So we prefer to explain the issues to the clients, because we don't necessarily understand their tax tolerance, and they can make an informed decision. We view that that's the best role for us. So there's lots of scenarios like
that. You brought up a good point, and a lot of strategies that we've used with clients where you sell a property, you buy a property, for all cash, you sell it, you have no debt on it, and you go buy a new property, you defer the taxes. How long after, owning that new property can you go out and take a loan on it, tax-free?
So for as long as I've been in the industry, the IRS has sort of hinted that maybe they would provide guidance to that, and they just haven't. Now, what I'll tell you is a certain type of property known as a zero coupon or zero cash flow, where you're buying, usually it's a CVS or a Walgreens that comes preloaded with a very high LTV, between 85 and 90%. They'll have what's referred to as a springing liquidity event. So you buy it, and maybe you buy it all cash, and then it's an automatic refi for 90%. So this is a way of doing a 1031 exchange, deferring the tax, and getting a whole bucket of cash that you can use for other things. So there's a segment that is based on a rapid refinance, and it's billions of dollars. And the IRS or states haven't really overruled that. Yet you can't take money out of a transaction on the sale, but you can on a refinance. So years ago, we were at a tax conference, and the chief attorney who was in charge of 1031 at that point gave what has been referred to as the magic pen rule, which is that you're sitting here in this closing room and you sign the documents for your purchase. You put this pen down, you go next door, you pick up a different pen, and you sign the documents to refinance. What she was trying to explain, this attorney for the IRS, was as long as it's two separate transactions, it can be that close. So that is the way that we explain it like that. And then we offer, because there's really not guidance on this, is obviously the further away you get from your sale to your refinance, is probably less gray. The one big crossing the Rubicon risk is probably having your refi preloaded into your purchase, that it's automatic. It has to be two separate and distinct steps. You purchase and then you refi.
Yeah, we've two separate transactions, two separate pens, blue and black ink.
Right.
Okay,
Exactly.
got it.
I've heard clients talk about how they would do it where you just don't even start the refi process until you've sold.
Yeah.
You can talk to your mortgage broker, obviously, but remove the email threads, just play it safe. Don't be a knucklehead. You basically know what it'll look like.
Play by the
broad
rules.
strokes.
Yeah.
And play by the rules.
That's very helpful, though. I think the audience would appreciate that, because that's some, advice that we've given to a lot of clients over the years. That's been a, big strategy.
We see, a lot of data in New York about, velocities down, 50% and stuff like that. How do you guys, are there any kind of data points or sort of intuitive gut feeling that you guys have about what the velocity is like, or the dollar amount, currently in your QI account versus maybe 6 months ago? How are you guys, what's your perspective on velocity?
So that's trying to figure out how much money you're making, because we know that's we know you charge interest on the account, right? That's very nominal.
They're
fee.
walking into the trap zone. Let them walk.
Very nominal fee to set up the 1031, right? And then
we brought financials.
Okay.
No. This is not an audit.
Please put it up on the screen.
You are not getting audited at this table. I am more curious to know, if you guys, kind of how Joe and I have, we know how many BOVs we're doing, we know what's on market. It's kind of leading indicators about, the market prior to closings actually happening. And I'm curious if you guys have kind of some foresight that you guys could share about.
I mean, we've definitely seen a decrease in velocity. As also seen it, I think some of the larger transactions have slowed down. Hopefully, we're starting to see the light at the end of the tunnel with some of that. But as far as percentages, what do you think?
Look, you guys are our canaries in the coal mine, right? When you first start talking to people about listings, that may be a deal for us, 90, 120 days later. So when your phones start ringing, we're downstream, and likewise, when you guys get cut off, we're still working at the residuals of the deals that you had in the pipeline. So, we're down call it 30%. Call it 30% or something like that. And we've taken a pummeling, especially in New York, where there was rent regulations a bunch of years ago, and that kind of stifled things. We've had banking crises, right? There's always been a speed bump, COVID, a bunch the last few years. And more recently, interest rates did their job. They jacked up interest rates to slow the economy, and it also slowed real estate down. What I think we see now, and this is just my personal opinion from watching Bloomberg News from morning to night, trying to decipher the tea leaves, is that there's pent-up demand that people know rate cuts are coming, even if they're not going to be big. They're not going to come in March. So the people that can wait are waiting right now for the other shoe of rate drop to fall. And I think that we're preloading for the last half of this year.
Yeah,
right now.
And just to be clear, I'm not I was kind of curious, just because we sell a building for someone doesn't mean they're doing an exchange. So a lot of the clients that we're working with now actually are not doing exchanges.
We don't like to hear that.
Yeah, I know. I'm sorry, but a lot of them just aren't.
That's mainly because of interest rates.
Yeah, or they're they're over leveraged. So they're
another problem.
They can't do the exchange, right? Because they're 75% levered on their New York asset, but to go buy the shopping center, and at least you can only get 50 or 55% debt. So they're like, holy crap, I can't do the exchange. I can't even sell right now. So that's kind of a lot of the conversation.
Keep in mind, people refi properties they still have a tax liability when they sell, despite the fact, potentially depends on the numbers. But we've seen a number, and we probably haven't seen it since around 2008. Where was it? Around there, we've had a couple transactions where they're deed in lieu, where they're handing the keys back to the building, but they're still considering a 1031 exchange, because even though they're not generating any cash from the give back of the property, they still owe taxes.
And then
that's a big problem, right? Because their LTV to equity ratio is not there, and that makes it really challenging.
Debt has nothing to do with gain.
Right.
Debt has nothing. Right. So if all along the way that you got value out of the building, which a lot of multifamily owners did over the years, you just refi a whole bunch of years, because especially prior to rent regulations changing, the properties weren't cash flowing much, but they were going up in value. So they would just keep refining out the value. Now all of a sudden the market retreats because of either 2008 or rent regulations or something. Now you've taken all the equity out, but you still have that huge tax liability.
Right. Yeah.
And that's where some, as Matt pointed out, you see deed in lieu, and people are like, but I have no cash left in the building. How could I owe taxes? Yeah. Well, because you took it over the course of the last 20, 30 years.
Yeah, you got to sell the boat. Sell the boat.
Yeah.
Sell the boat.
But Todd, I agree with you. I think the back half of the year is going to be extra busy. We're already starting to see it as an increase in BOVs and uptick in activity, new buyers coming into the market. So I think it's going to be a busier year for you. So I want to make you guys happy as you walk.
Yeah,
we feel much better.
And we really appreciate you coming in here. It was really good advice that you give, because you give advice and information, right? And
flash the disclaimer.
And just how can everyone get in touch with you? Legal1031.com?
So it's really easy. Todd at legal1031.com, Matt at legal1031.com, and our 800 number is 877-701-1031.
That's an easy one.
Joe, I don't know if you've thought about this, but we're always looking for exchange buyers. Like, how do we find them? Like, quality exchange buyers. Just call